Obviously for all of us, it's critical that we stay close to the latest and greatest information. Things seem to be changing by the hour. I've spent most of my morning talking to carriers, talking to some clients, just talking to industry colleagues. So any new information that's come up, I'm trying to stay on top of it. So what I was thinking is I'd run through about 12, 15 different points, just sort of industry overlaying things that we're seeing and what's happening and sort of the residual effects. And then we can drill down into some of these specifics as well as questions come up. All right. So, initially once coronavirus had come out and started to hit the press, that obviously coupled with Lunar New Year in China, we saw the reduction of imports, some of that just due to natural Lunar New Year, and then some of it with factories extending their closing. So, the initial call out that we saw was obviously carriers kind of bucking at accepting loads going into California because they didn't have that port volume to secure a load coming out. So port volumes in LA and Long Beach are down 23% year on year in February, which some of that is very natural based on Chinese New Year, but some of it is certainly attributable to the extended closings for China-based manufacturers. So nothing really new there. The big thing that we are definitely seeing in-house and across the industry is we're seeing a higher rejection rate of negotiated pricing. So, just yesterday I was talking to a carrier and they had a very specific and telling quote. Rates for this Southern California to Washington lane that normally run at about 1,800 like clockwork, yesterday went for 2,700. And I can speak very specifically to some other negotiated lanes that we have in place where I'm seeing even higher on a percentage basis, higher increase requests than that. So truly some unprecedented times. In terms of carriers, we're aware of some smaller assets that are suspending operations. But what was interesting yesterday in speaking with another carrier is they brought up a good point, which is kind of staring us all in the face. Some of these drivers that maybe are over the age of 60, they're pulling themselves right off the road. They're in a higher risk category based on, what's being reported in the media. So that's definitely impacting capacity as well. I think we've all gone through the struggles of going to your local supermarket or CVS and trying to get any sort of paper product or, bottled water and things like that. So from a capacity standpoint, all those industries are just going forward full throttle. So that's obviously creating challenges in and of itself. A very telling statistic that would be good for everybody to report back in. So the outbound tender volume index is currently over 12,000. And to put that in perspective, it's indexed at 10,000. So anything above 10,000 indicates some expansion or growth. And just to have a little bit of perspective on that, we didn't hit 11,000 at all in 2019. And overall volumes are up 21% in the last month alone, and that's on the truckload side. Now, some of us, for this next point, some of this is going to hit home a little bit more for some of us than others, but next month is going to be end of month, end of quarter for a lot of shippers. So as bad or as challenging as things have been this week, next week is going to be even more challenging. People still have budgets that they need to hit. They still have financial targets that they need to hit. So our perspective is that next week is going to be extremely challenging. And we are obviously here to help support in any way possible, whether you're a client or not. Yesterday or the day before, the big three automakers announced that they're closing all U.S. factories through the end of March. Maybe that'll help free up some capacity, but we'll be monitoring that as well. Manufacturing in China is definitely picking back up. We're starting to see the spot rates to the U.S. West Coast and East Coast of Asia creeping back up, which, in and of itself is a good thing. China releases a purchasing managers index similar to the ISM index here in the U.S. And anything that hits above 50 is indicative of expansion. So China released on 3/16 that their purchasing managers index hit 50.8. Now that's an 8-month high. So yes, it's creeping into that sign of expansion, which says that they're economic recovery plan that they've been unveiling is starting to work, but more to come on that. The other thing that's telling us that manufacturing is coming back up is the uptick in intra-China air freight. So this tells us that all the raw materials, raw materials needed for production are being moved to the factories for final assembly and production. And this has also resulted in a big uptick in air freight to the U.S. Air freight rates alone to the U.S. are up 27% just over the past 2 weeks per the TAC index. Now, based on all the flight cancellations, obviously the airline industry has taken a complete beating. Flight cancellations have removed 5,100 tons of capacity each day from China. So overall capacity is down 36% year on year. Now you see the uptick of air freight for people that need to replenish inventories. And that's obviously a recipe for rates to go up. I want to say the average cost per kilo coming into the U.S. was about $3.50 a kilo. And again, that's very blended, obviously, depending on where you're sourcing from and when you're delivering to, that cost per kilo could vary. We did hear about FedEx Freight yesterday, just shifting over to LTL, allegedly refusing to pick up from or deliver to both San Francisco and Philly. San Francisco, as most everybody knows, has a shelter in place. Philly's closed down all non-essential businesses, and the state of Pennsylvania has actually closed down all truck stops. We're trying to confirm this, but I did talk to somebody again this morning who's saying that is true. I'm in regular communication with all the major LTL players, and everybody, as of right now, is operating business as usual, with the caveat being that they have obviously some different policies and procedures in place just to ensure employee safety. Fuel. So the price of diesel continues to plummet. This week, the EIA released its $2.73 per gallon. That's the U.S. national average for diesel, and that's 11 straight weeks of declines. Crude, the WTI crude closed yesterday at under $23 a barrel. It was over $65 a barrel in April of 2019. And if any of you remember, all the way back in 2008, we saw highs of over $145 per barrel. So we're a long way from those times for sure. And the price of Brent closed at under 30 as well, about $28 yesterday, and that was over 70 in April of 19. One other point of interest is that the American Trucking Association president and CEO has sent a formal letter to President Trump and Vice President Pence just about some things that the trucking industry is looking for them to comment on and to rule on. As we know, the hours of service restrictions have been halted for anybody who is hauling those emergency supplies. But then when we look at places like Pennsylvania who've closed rest stops, one of the asks there was to keep those rest stops open. And then another good call out in this letter that I'm reading here is, many states are shuttering their DMV facilities. And what they're asking for is support for the truckers who either need to renew or obtain a commercial driver's license credentials, and how are they going to respond to all that. And then there was a comment about testing too. So obviously this is at the forefront for everybody. Another article that I was reading recently is if God forbid all trucks stopped, our supermarket shelves would be completely empty within 3 to 4 days. So it's not exactly a go hug your local trucker thing, but it just really shows how important the trucking industry is to all of us. Not only through these most trying of times, but just during normal operations as well.